What the rich do to avoid paying taxes. 13 ways revealed. As we all know, the rich are different from you and me. They have more money for one thing. And they also seem to have figured out how to avoid paying taxes on much of their wealth. The rich have a lot of tricks up their sleeves to avoid paying taxes. But what exactly do they do? And more importantly, can we learn from them and use some of their tactics to help us pay less tax too? This is Capitalist Domain, and in today's video, we are going to show you the 13 different ways that wealthy people do to avoid paying taxes. Now, I'm not saying that these are illegal methods, but they are definitely clever loopholes that can help you save a lot of money on your tax bill. Some of them are simple, while others are a bit more complex, but all of them work well. So whether you're just trying to get ahead or want to pay as little tax as possible, this video is for you. Stay tuned. Number 1. Offshore Accounts. By keeping their money in offshore accounts, the rich can avoid paying taxes on it. This is because the money is not considered to be in the country where they reside, so they don't have to pay taxes on it. One example of this is in the Cayman Islands, which is a popular destination for offshore accounts. The government there doesn't tax income or capital gains, so it's a great place to keep your money if you want to avoid paying taxes on it. Another popular destination for offshore accounts is Switzerland. The Swiss have a long history of banking secrecy, and they don't tax foreign earned income. So if you have an account in Switzerland, your money isn't subject to taxation. The problem with offshore accounts is that they can be used for illegal purposes, such as money laundering and tax evasion. So if you're thinking about using one, make sure you understand the risks involved. Number 2. Luxury items. The rich love to buy luxury items, and they often do it as a way to avoid paying taxes. For example, let's say you buy a yacht. You can then claim it as a business expense because you can use it to entertain clients. And if you charter it out, you can write off the cost of maintaining it. You can also avoid paying taxes on art by buying it through a private sale. If you buy art through a public auction house, you have to pay taxes on it. But if you buy it privately, you don't have to pay any taxes. Also, if you buy a luxury car, you can deduct the cost of maintaining it as a business expense. This has always been a popular way for the rich to avoid paying taxes. Number 3. Trusts. Another way the rich avoid paying taxes is by taking advantage of trust. Trust allows the wealthy to avoid probate and estate taxes, as well as gift and inheritance taxes. By using trusts, the rich can ensure that their assets are passed on to their heirs without being subject to taxation. For instance, let's say you have a $10 million estate. If you were to die and your heirs were to inherit your estate, they would be subject to estate taxes. However, if you create a trust and fund it with your $10 million, your heirs would not have to pay any taxes on the inherited money. The use of trust is a common tax avoidance tactic employed by the wealthy, and it's one that can be quite effective. If you're looking to avoid paying taxes, setting up a trust may be a good option for you. Number 4. Charitable Foundations. Donating money to a charitable foundation can help the wealthy reduce their tax liability. The rich often create their own foundations and donate money to them. This allows them to get a tax deduction for the donation while also having control over how the money is spent. In most cases, the wealthy donate money to charities that they are already involved with. This allows them to get a double tax deduction, one for the donation and one for the time they spend volunteering. Number 5. Shell companies. The term shell company might make you think of a shady business dealing in the back alleys. And while there are some illegal uses for shell companies, they can also be completely legal. A shell company is simply a company that doesn't have any active business operations. It might have some assets, but its main purpose is to hold money or investments for its owners. And because shell companies don't have any real income, they can be used to avoid paying taxes on that income. For example, let's say you own a successful business. You could set up a shell company in a country with lower taxes and then funnel your profits into that company. The shell company would then pay taxes on its income at the lower rate, and you would only have to pay taxes on the money when you eventually took it out of the company. Of course, this is all perfectly legal, as long as you declare the income and pay the appropriate taxes on it. But if you don't declare the income and don't pay taxes on it, then you could be facing some serious penalties. Number 6. Home office deduction. By claiming a home office deduction, the wealthy can lower their taxes by deducting a portion of their rent or mortgage payments. They can also deduct the cost of utilities, maintenance, and repairs. While the home office deduction is available to anyone who uses a portion of their home for business purposes, the wealthy are more likely to have the extra space and resources to set up a dedicated home office. Number 7. Capital gains. When the rich sell investments, they often pay lower capital gains taxes than ordinary income taxes. This is because capital gains are taxed at a lower rate than other forms of income. For example, let's say you sold stock for a profit of $10,000. If you were in the 25% tax bracket, you would owe $2,500 in taxes on that income. But if you were in the 15% capital gains tax bracket, you would only owe $1,500 in taxes. So if you're in a high tax bracket, it may make sense to invest in assets that will generate capital gains rather than ordinary income. Number 8. 1031 exchanges. A 1031 exchange allows investors to defer paying capital gains taxes on the sale of investment property by reinvesting the proceeds into another property. To do a 1031 exchange, you have to follow some pretty strict guidelines. For starters, you have to identify the property you want to purchase within 45 days of selling the original property. You have to close on to the new property within 180 days of selling the original property. And the properties have to be like-kind. Like-kind property is generally defined as investment or business property. So you could exchange a rental property for another rental property, or an office building for another office building. But you couldn't exchange a rental property for a beach house. If you do a 1031 exchange, you can defer paying taxes on the sale of your investment property indefinitely. That's why it's such a popular tactic among wealthy investors. Number 9. Tax-free investments. This means that the interest you earn on these investments are not subject to tax. This can be a great way for high-income earners to invest their money without having to pay taxes on the earnings. Investments that are exempt from federal income tax include municipal bonds, U.S. government bonds, certain foreign government bonds, and certain types of mutual funds. By investing in this type of investments, you can keep more of your money instead of paying taxes on it. Number 10. Employee Stock Ownership Plans or ESOPs. ESOPs allow employees to avoid paying taxes on the stock they receive from the company. The stock is held in a trust and the employees don't have to pay taxes on it until they sell it. Through an ESOP, companies can deduct the contributions they make to the trust from their taxes, and when the employees eventually sell their stock, they only have to pay taxes on the gains, not the original value of the stock. Number 11. Health Savings Accounts or HSAs. Health savings accounts are tax advantage accounts that can be used to pay for medical expenses. Contributions to HSAs are tax deductible, and withdrawals for qualified medical expenses are tax-free. Rich people take advantage of HSAs by contributing the maximum amount each year and using the account to pay for routine medical expenses. This allows them to deduct the contributions from their taxes and avoid paying taxes on the withdrawals. Also, any money that is not used in the current year can be carried over to future years. Number 12. Qualified retirement plans. Qualified retirement plans such as 401ks and individual retirement accounts or IRAs offer tax breaks to encourage people to save for retirement. A 401k plan is an employer-sponsored retirement plan. Employees can contribute pre-tax dollars to the account, and the money grows tax-deferred. Withdrawals from the account are taxed as ordinary income. With a 401k, you can contribute pre-tax income, which lowers your taxable income for the year. For example, if you contribute $10,000 to your 401k, your taxable income will be reduced by $10,000. This can put you in a lower tax bracket and save you money on taxes. An IRA is an individual retirement account that anyone can open. Contributions to an IRA are tax deductible, and the money grows tax-deferred. Withdrawals from the account are taxed as ordinary income. For example, you can only deduct IRA contributions if you don't have a workplace retirement plan. Qualified retirement plans are a great way for high-income earners to reduce their taxes. By contributing to a 401k or IRA, you can lower your taxable income and save money on taxes. Number 13. Life insurance. The death benefit from a life insurance policy is generally tax-free. So if you have a life insurance policy with a face value of $1 million, your beneficiaries will receive that full amount when you die, and they won't have to pay any taxes on it. The wealthy often use the life insurance as an investment tool. They take out policies on their own lives and name their children or their loved ones as the beneficiaries. The cash value of the policy grows tax-deferred, and when the policyholder dies, the death benefit is paid out tax-free to the beneficiaries. This strategy can be especially beneficial if you are in a high tax bracket. By using life insurance, you can effectively transfer wealth to your heirs at a lower tax rate than they would pay if they inherited the money from you directly. Of course, life insurance can also be a valuable tool for estate planning even if you don't have a lot of money. If you have young children, for example, a life insurance policy can provide financial security for them in the event of your death. Just be sure to purchase the right type of policy. Term life insurance is generally the most affordable option, and it provides coverage for a set period of time, usually 10 to 30 years. Whole life insurance is more expensive, but it provides lifelong protection and builds cash value that you can borrow against or cash out later in life. Universal life is a type of whole life insurance that offers more flexibility in how you use your policy. Takeaway: when it comes to saving money on taxes, the rich know what they're doing. By taking advantage of tax advantage accounts and investing in life insurance, they are able to keep more of their money and pass it down to their heirs at a lower tax rate. If you want to save money on taxes, consider using some of these strategies yourself. Share this with your friends and family to let them know about the 13 useful tactics we discussed. Also, don't forget to like and subscribe if you found this video informative. Do you know any other ways the rich avoid paying taxes? Let us know in the comments below.